When is it most appropriate to use EBITDA? It can be particularly useful when comparing companies within the same industry, especially those that might have different capital structures or depreciation methods. It helps to level the playing field by removing some of the variability caused by financing and accounting choices within the same sector. EBITDA can also be helpful in analyzing the operating performance of companies that are not yet profitable but have positive gross margins. In such cases, it can show the potential profitability of the core business before accounting for interest and taxes. Additionally, EBITDA can be used to assess the potential profitability of a business before considering the implications of its financing and tax structure, which can be especially relevant in the context of mergers and acquisitions. However, there are times when relying solely on EBITDA is not appropriate and can even be misleading. It should not be the primary metric for companies that have high capital expenditure requirements, as it doesn't reflect the significant cash outflows needed to maintain and upgrade their assets. Similarly, it can be misleading for companies with significant debt burdens because it ignores the often substantial interest expense associated with that debt. In situations where a company's earnings are significantly affected by interest and taxes, EBITDA will not provide an accurate picture of its overall profitability. Ultimately, EBITDA should not be used in isolation. It's important to consider other profitability metrics that provide a more complete financial picture. For a more comprehensive investment analysis, it's crucial to consider other financial information and qualitative factors alongside EBITDA. Looking at net income is essential to understand the full profitability picture, as it takes into account all expenses, including interest and taxes. Analyzing cash flow statements is also vital to assess the actual cash a company generates and uses, which EBITDA only approximates. Understanding a company's capital expenditure is important to see how much it's investing in its assets for future growth. Investors should also consider a company's interest expense and debt levels to evaluate its financial risk and ability to meet its obligations. The impact of tax expenses is also relevant, as taxes are a real cost that affects profitability. Additionally, looking at other profitability ratios like gross profit margin and net profit margin can provide further insights into a company's financial performance at different levels. Finally, don't forget to consider qualitative factors such as the quality of the company's management, the trends in its industry, and the competitive landscape it operates in, as these can all significantly impact its future success. Watch our other videos to learn more about EBITDA.